Hello friends, welcome to the third video of the series of NISM Series XV Research Analyst Examination. Hope you found the last two videos useful. The last two videos were on chapter 1 and chapter 2 of the booklet, and this one is going to be on the chapter 3, that is terminologies in equity and debt markets. This video is very important because it lays up the foundation for the research analyst examination course, because you will learn a lot of new terminologies which we are going to be going through in this chapter. So first let us understand what is the difference between equity and debt as an investor. You can invest in equity through shares, as you know. You can invest in debts through bonds. So at the same time, it's very important that you know what is the main differences when you invest in equity and when you invest in debt. Let's talk about ownership. In case of equity, the shareholders are the owners also. So depending upon how much stake you have in the company, you are also part owner of the company when you are investing in equity. While in case of debt, you are basically just giving out money for the company as a loan. So basically you are just allowing the company to take care of its operating expenses or to maybe invest in new areas, but you are not being the owner. In that case, you are just being a lender to the company. Let's talk about returns. In case of equity, there is no guaranteed returns. You can see that depending upon the market price of the share when you had invested, you can see a downfall or you can see a rise depending upon how the company is performing. While in case of debt instruments, it's basically loan. You will come to know how much interest rate they are going to give you at the time of maturity. So the returns are mostly fixed. When you come to risk factor, in case of equity, there is a huge risk involved. So companies can go bankrupt, your share values can go down, and the values are basically fluctuating a lot, even if we talk about big companies. While in case of debt instruments, since the interest rates are mostly fixed, there is very low risk involved. Of course, there is credit risk involved. That basically means if the company to whom you have lended the money goes defaulting on the loan, then of course there is a risk, but that risk rating is also something that you already have handy, so the risk element is very less in debt. Let's talk about management rights. In case of equity, the major decision inside of the company, you as a shareholder can also participate in. You have the voting rights, you can be also participating in the major decisions. While in case of debt instruments, you're just lending money. You are not being any owner of the company, so you don't have much participations when it comes to any decision making in the company. Let's talk about capital duration. In case of equity, the amount that you are putting in is almost permanent. You can keep the money as much long you want. But in case of debt instruments, since it's only borrowed money for a certain duration of time, it has to be coming with a capital duration that could be like 1 year, 2 year, 5 year, or 10 year, or 30 years for that case. Let's talk about profit claims. In case of equity, how the company is giving you the profit is after it has paid off the debt. Let's say it has given out the equity shares and it has also taken some loan from other people. So what when happens when the company is getting any profit, it would pay off all the debt first, and whatever residual profit is there, that is what is shared with the shareholder. While in case of debt instruments, what is going to happen is that only fixed interest is and the principal is what gets paid. So doesn't matter if the company is doing pretty good, you will only be entitled to receive whatever the fixed interest rate has been agreed in the bond paper. Now let's understand what is the face value of the share. The face value of the share is often referred to as original value of the share also. So oftentimes many people confuse face value of the share with the price market or the market share value of the share. They are two different things. Face value of share is very much theoretical number. So as to understand it better, there can be companies who got listed, and at the time the face value that was allotted to this particular share could be 2 rupees or 10 rupees, and they can very well be trading in 100 rupees, 150 rupees market price share. So you have to understand face value of share is just a theoretical value, or you can also call it original value of the share. Usually the face value of a share will remain same throughout its life unless there is something like a split or a consolidation of the share happening. So if the company comes out with a rule that okay, every share will be splitted into two, then you will see that the face value of the share will reduce to half. So initial face value, if it was 10 rupees, it would go to 5 rupees. It can also happen that the shares can get consolidated. That would mean that two shares will be joined into one. So then the face value would be double of the initial face value. So if it was 10 rupees per share, then the final face value of the share will become 20 rupees as a result of consolidation of the share, which is just opposite of splitting. Let's understand what is total equity capital. Equity capital is easy to calculate. You just have to multiply the number of shares with the face value. So if say you have 1 lakh shares, if you multiply by 10, you get 10 lakh rupees capital. That is called as total equity capital. It doesn't have again much relevance in the real life scenario. Let's first understand what is par. Par is basically nothing but face value of a share is what is par. Okay. Whenever the shares are issued, it can be issued in two ways. One, when the prices are more than the face value, and second, when the prices are less than the face value. Most of the time, it is always issued with a premium. Okay, so that's the reason why I said the real share value is always higher than the face value most of the time, because the shares are always sold or bought with a premium amount added to it. So how can you say that the share is issued at a premium? Whenever the price of the share is more than the face value, you call it the issue as premium issue. Whenever the price is less than the face value, you can call it a discount issue. Okay, why we have to still study face value of a share is because of dividend. Oftentimes when the dividends are paid out for any company, they are always described as percentage of the face value. So for example, whenever you are getting a declaration saying 30 percentage dividend on particular share, so it's not 30 percentage of the market share price. Maybe 150 rupees is the market share price. You are not going to get 30 percentage of 150 rupees. All you are going to get is 30 percentage of the face value. That could be just 10 rupees. That means 3 rupees per share. Previously there used to be a lot of confusion because the market share was 100 rupees and somebody got that dividend getting declared of 30 percentage and they expected 30 rupees to be credited, and eventually it was found that this percentage basis of declaring dividend is not good for Indian markets, because somehow people have still this confusion between face value and the market value. So then government decided that dividends will not be declared in percentage of the face value, but rather the amount itself, saying that 1.5 rupees per share or 3.5 percentage rupees per share, not as percentage. Okay, so but before that the dividends were always declared in percentage value of the face value. So 30 percentage dividend would mean that 10 rupees face value would fetch you 3 rupees per share. Okay, hope you got the context clear. Now let us understand what is book value. Book value is a theoretical value of the share if the company were to wind up. Okay, so for example, if the company is going to wind up, it's not the equity capital that would be at stake, but also the reserves that are there will be at stake. So in order to find out the book value of the company, you are not going to only take into account the equity capital, you would calculate the entire net worth of the company. Net worth is calculated as equity capital plus reserves, and you will divide it by number of shares, and that will give you the book value of the share. Whereas market value is something that you already are aware of. We don't call it by market value, we just say the price of the share, right? Because that is the price at which the shares are traded in the stock market. It, depending upon the company's prospects and investor sentiments and liquidity and all, the market value of each share can vary in many different ways. Let's say, what do you understand by market capitalization? Okay, this is an important thing. What is market capitalization? Market capitalization is the amount of money required to buy out the entire company at its current market price. Let's say understand, let's say you want to find out the market capitalization of a company. All you need to do is to find out the current value of the share in the share market, that is a market value, and multiply it by the total number of outstanding shares that is there in the market, and then you can find out the market capitalization of a particular company. Why market capitalization is important? Because market capitalization gives the total equity value in the market for any company, and based on this market capitalization is how we determine whether a company will fall under the top 50 companies or next 200 to 500 companies, or if we call them small cap companies. So market capitalization is the way to determine if a company is a small cap, mid cap, or large cap company. What is large cap companies? The top 50 and 100 companies as per market capitalization are large cap companies. Notable names are Reliance and TCS. Mid cap companies could be next 200 to 500 companies in this list, and small cap companies would be smaller companies which are after 500 companies or the top 500 companies. So this is how we can divide the entire market into three caps: small cap, mid cap and large cap. Oftentimes it is found that the large caps have very high liquidity, whereas small companies will have not that much liquidity. But at the same time, opportunity wise, if you look, the smaller companies can give you better returns because of the risk that is involved. Now let's understand what do you mean by replacement value. Replacement value would mean that if I have to start, or if I have to buy the entire assets of the company today, how much money would I have to put in, is what the replacement value of the company would mean. Okay, it's not that the company is getting wound up or anything. Okay, it's like if I have a company A which has certain value in the market, and if I want to recreate the same company on today's market rate, then how much money would I need? That is what the replacement value would mean. Now let's understand intrinsic value. This is the most commonly used term in the entire market, and it is also the term which doesn't really have any much of formula. There's a lot of things that go into calculation of an intrinsic value of any company. Intrinsic value is the present value of expected future cash flows for the company discounted at a suitable rate. Oftentimes you say that there is a particular stock which is undervalued, or there is a stock which is overvalued, right? How do you know something is undervalued or overvalued? It's not only the just the price which determines it, also is largely dependent on the growth prospects of that particular company. Many people say that Apple is overvalued. Why they say is they think that the intrinsic value that they have calculated is basically very less than what the current market price is. That's why they say it's overvalued. But there might be some other person who might have determined the intrinsic value to be very high, because they think that's a very high growth prospects that the company has, and they might say that, oh no, at the current price also the company is undervalued. So it depends a lot on how you calculate the intrinsic value. If you find that the intrinsic value is more than the market price, you can say that yeah, it's an undervalued company, and you would say that okay, it's good to buy the company shares. While if you find the intrinsic value is less than the market price, you will say the stock is overvalued, and you would say that okay, it's better that you sell this thing. Now let us come to enterprise value. How do you find enterprise value? What is enterprise value? It's a theoretical price to acquire a company, including debt but excluding cash. This excluding cash is very important, friends. So what we are finding here is a theoretical price to acquire a company, including its debt but excluding the cash. And that's how you can remember the formula of enterprise value also, which is very important, because many numericals will come which will ask you questions related to finding enterprise value of any company. So what is enterprise value? It's the market value of the equity, that is market capitalization, plus market value of the debt minus cash and cash equivalent. For example, if you have a market capitalization of 20 lakh, debt of 3 lakhs and cash of 4 lakhs, how do you find EV or the enterprise value? You would add 20 plus 3 minus 4, that is 19 lakhs. So that is what the enterprise value of a company is, and EV reflects the true value for a buyer. You will come to know the true value of any company if you are going to buy this company by knowing the enterprise value. What is earning? Is the profits available to the shareholders. What is historical earnings? The past reported profits would be what you term as historical earnings. Trailing earnings, earnings for the last 4 quarters on the rolling basis, is what we call as trailing earnings. Forward earnings, projected profits based on estimates. It can be given by the company itself. You can see how they are projecting the future profits to be. Earning per share. Earning per share shows the profitability per share. Earning per share is easy to calculate. Again, this is a very common question that is asked in the exam. Earning per share is calculated as net profit divided by number of shares outstanding. So for example, if you have 10 lakh rupees as net profit, number of shares is 2 lakh, so earning per share will be rupees 5. So we often say that higher the earning per share is more attractive for the investor. So if you are getting more earning per rupees that you are putting in, then that is attractive for an investor, right? Dividend is paid to shareholders as a portion of the profit. How is dividend calculated is something that I had explained you even earlier. Let's go through it once again. Dividend is calculated as dividend percentage multiplied by face value. For example, dividend declared is say 40% and the face value of the company is, let's say, 10 rupees. So 10 multiplied by 40% is going to give you rupees 4 per share. So if this person has say 100 shares, then he will get 400 rupees, that is rupees 4 per share. Price to earning ratio, PE ratio, it indicates how much the investor is paying per rupees of earning. Okay, this is very important ratio, friends. PE ratio. Okay, how do you find PE ratio? PE ratio is found out by market price per share divided by earning per share. So market price per share basically means the shares price at which the particular share is trading at. If let's say it's 100 rupees and the earning that it has got is, let's say, 5 rupees, then P to E ratio is found out by 100 divided by 5, that is 20. So PE ratio 20 basically would also mean that I am ready to put in 20 rupees for every 1 rupee of earning that I can get out of it. Okay, that is how you can put it in a simple sentence. So P to E ratio means it indicates how much the investor is ready to pay per rupee of earning. Okay, higher PE suggests expected growth, lower PE indicates undervaluation. So if you see that the PE is very high, then it basically means that there is a very big growth. When else at the same time, if there is lower PE, it can say that it's undervalued company. But again, this is depending upon the context. If you have lower PE, though it might sound very attractive, it could also mean there is some problem going on in the company because of which the PE ratio is low, and that's why it's showing as undervalued. Doesn't mean that you should now invest in. Whereas higher PE ratio also doesn't mean that you should stop investing in it, because there are people who are ready to put in that kind of money, which is raising up the price value of the share, and that's why the PE might be very high, but it might still be a very good investment opportunity. Let's go to price to sale ratio. What is price to sale ratio? Price to sale ratio is found out by using this formula, that is market capitalization divided by annual sales, or market price divided by sales per share. Okay, finding out using the formula is very easy. Annual sales, let's say, for a company is 1 crore rupees, and total number of shares that are out there in the market, let's say 10 lakh rupees. So sales per share is found out as rupees 10, and you know the market price of this thing is, let's say, 40 rupees. So price to sales would be 40 divided by 10, that is 4. Okay, very easy to find. When only thing you need to find out is sales per share, and then once you have found that out, you know the market price, and you just divide the market price divided by sales per share, and you will find out price to sales ratio. Okay, so if you find the situation where the low PS ratio is there and there is a strong sales growth, then that would indicate it's a very good potential to buy into this company. Now let's find out what is price to book value ratio, that is P to BV ratio. That is found out by market price divided by book value per share. Okay, let's take an example. Let's say there is an equity capital of 10 lakh rupees, reserves of 50 lakh rupees, and shares of 6 lakh rupees. So how would you find out the book value? Market price first you will find out. So market in order to find out the market price, you would add the equity capital plus reserves, that is 10 plus 50, that is 60, divided by 6 lakhs. Okay, that is the number of shares that are there in the market, and by doing this you are able to find out the book value. Okay, so book value is very easy to find out, right? You know the equity capital, you know the reserve, you will add both of them and you will divide it by the total number of outstanding shares, and you will get the value which is called as the book value of the share. Now you have another formula which you have to remember. Book value is equal to net worth divided by number of shares. Okay, that is net worth of a share is equity capital plus reserves divided by number of shares. Okay, this is the formula that you had used. So market price is 20 rupees, P to BV is 20 divided by 10, and that gives you P to BV ratio, which is 2. Okay, so finding out P to BV ratio is very easy. Once you have found out the book value, and when you divide this price by divided by book value, you will get the value of P to BV ratio. If you find that P to BV ratio is less than 1, that basically means that there is a undervaluation in that particular share. Okay, so but if you find that there is a P to BV ratio more than 1, that basically means it is either in par, or it can also be meaning that it's overvalued. Okay. Now let's find out what do you mean by differential voting rights. Differential voting rights means shares with fewer voting rights per share, issued to raise capital without diluting control, usually traded at a discount to the normal price. Sometimes what happens is that the company wants to raise capital, but they don't want to give away the voting rights to people. So in that cases, they can launch some shares which will give them differential voting rights. Oftentimes, since they don't come with voting rights, these shares can be typically of lower price than the market value of the share. And they are also normally traded in the market, but if you are not somebody who is looking into getting a stake in the company, this is a good way to invest in, by investing in differential voting right shares, which would basically mean that you will not have any voting rights in the company, but you can still invest and get profit out of the company. What is debt security? In case of debt security, there are two people. One is issuer who borrows the money, and there is investor who is going to lend the money. Okay, who is giving the money. Even we can play different roles each time. Say, for example, if I am taking out a loan for a home, so I am being the person who is taking the loan. I am basically the issuer then, and the bank is going to give me the money, so it becomes the investor. Or at the same time, it can go in the case otherwise, where you borrow or you lend the money to another company, so you become the investor, and the company which is taking the money from you becomes the issuer. For example, a company needs 100 crore rupees. There are only few options that this company has. One option would be that it takes a loan from the bank. Okay. Second option would be that this company can issue debt securities. What it could do is, like, in order to raise 1 crore rupee, 100 crore rupees, it would put out bonds of 100 rupees face value each, and it would give 100 crore units of these bonds out in the market. So investor who is going to pay, let's say, 1000 rupees, will get 10 securities each of value 100 rupees. And this way what he can do is to raise 100 crore rupees. All he needs to do is get this 1 crore units out in the market, each of 100 rupees value, and he can get the maximum exposure by so many investors who are investing in. With banks, oftentimes the decision is centralized on, they can decide whether to give or not. But at the same time, when you have such type of exposure where there are so many people who have invested in these debt securities, you get a major exposure, being a person who is in need of the loan. There are few terms that you need to understand here. One is principal. Principal means the amount borrowed. Coupon is the interest rate. Maturity is when the money is returned. Secured and unsecured means, if, say, for example, if I have to take a student loan, and if I don't have anything to put as a collateral, that will be termed as unsecured. If I have something like a house to put as a collateral, that will be considered a secured loan. Okay. What is face value? Face value again represents how much loan is represented by the particular debt paper, also called par. Okay, so herein also the face value has very little relevance. Okay, it's just the actual price that the each paper carried at the time when it was launched. Okay, usual value for the face value of share would be 100 rupees or 1000 rupees. Okay, whereas the market price could vary. It can be 113, 120, or any of thing for that exact share, or the bond in this case. Now let's understand what is coupon rate. Coupon rate basically means interest rate only. It can be paid annually or it can be paid semi-annually. So how do we find out the coupon? A coupon can be found out by multiplying the face value multiplied by coupon rate, and that will give you the coupon. Coupon basically means the amount, or the interest amount is called as coupon, and the interest rate is called as coupon rate. Okay, let's take an example, it will make it clear. Example is 8.24 percentage for the year 2018 at 1000 rupees. So all you need to do is 1000 multiplied by 8.24 percentage. So that gives you an annual coupon of 82.4 rupees and semi-annual of 41.2 rupees. So that basically means if I lend out 1000 rupees in the year 2018 at 8.24 interest rate, so end of the year I will get total interest amount of 82.4 rupees, and if I only invest for half the year I would get 41.2 rupees. Okay, simple calculation. What is maturity or tenor? Maturity or tenor is the time duration until the bond repayment. It can differ from each bond. There are treasury bills which will come with an expiry date of 91 days, and then there are GSEC which comes with 30 plus years of time duration. Okay. What is principal? Principal is the initial amount that you're putting in. What is redemption? Redemption would mean the return of the face value plus last coupon. That would basically mean the amount that you had put in plus the interest rate. Okay. And once you got this money back, then the bond is basically ceasing to exist. There is nothing, nothing will continue thereafter, right? Once you have got your money back, you have got the interest back, then the business is over. Now let's first understand what is holding period return. Holding period return or HPR is the return earned on investment during a specific period when it was bought and held by the investor. So there is a calculation which you don't have to remember. Sometimes only the questions are coming from this. But if you remember, it's good. At least it will give you one more additional marks. Okay, it's not a very commonly asked question. So finding out holding period return would basically mean, let's say I am taking an investment in bond and I invest it in it for like say 3 years, and after that I want taking my money back. How much return that I gained is what is holding period return would mean. It is not annualized return I'm talking about. I'm talking about for if I have a bond in which I invested for 3 years while the total duration was, let's say, 10 years, then how much returns did I gain during that period is what HPR will indicate. So if an investor purchases a bond of rupees 104 and earns rupees 8 as the coupon, which he reinvests at 7% for a period of 1 year, and finally sells the bond at 110 after 1 year, then his HPR would be. Okay, it's very important that you understand this question clearly. Okay, so I am an investor. I have put in a bond of 104 rupees, and at the one end of 1 year I got, let's say, interest rate of 8 rupees, and which I am again reinvesting for 7% period for 1 year. Then I'm selling this bond for 110 rupees, and after 1 year I just wanted to calculate how much is the HPR that I got. It's a scenario wherein you have reinvested your interest. Okay, so to find out HPR, what you would need to do is that coupon plus reinvestment return plus capital gains or loss divided by purchase price into 100. So what I have done is, in HPR I have put in 8 rupees, that is a coupon amount. I have put in the reinvestment return, that is 8 into 7%, that because that is the amount that I'm going to get when I'm reinvesting, right? So 8 into 7% plus 110 minus 404. So 110 is the amount at which I am selling, and 104 is for the amount which I purchased this. So 110 minus 104, and the whole thing I will divide it by 104, and that gives me a value of 14%. Okay, you can also try to do this calculation. Just read out the question and try to solve it yourself, and you will get the grasp of this thing. Okay, it must be noted that the HPR is a single period return and is not an annualized return to the investor. So though you see 14%, that doesn't mean that it's 14% for per year amount. Okay, it's for the duration to which this person has holded that bond paper. Now let's understand what is current yield. Current yield is a simple method of calculating the return on debt security in which the coupon is divided with the current market price of the bond and the result is expressed in percentage. Okay, that is what current yield means. Say, let's understand with an example. You have an coupon which of 8.24% is the coupon rate for 2018, and it is trading for 104. The current yield is easy to calculate. What you need to do is 8.24 divided by the market price, which is there 104, and that will give you a figure of 0.07923, which you multiply by 100 and you get 7.92%. That is what the current yield is a value. Okay, so this is a simple method of calculating the return of the debt security in which the coupon is divided with the current market price of the bond and the result is expressed in percentage. Okay, now let's understand what is yield to maturity. Oftentimes yield to maturity is also referred to as internal rate of return. Okay, yield to maturity doesn't have any fixed formula. You can only do it in an Excel sheet. You can see in the Excel sheet there is XIRR is what you are going to use. You can see the formula in the Excel sheet and you can try applying that. What this method does is it takes into consideration all the future cash flows coming from the bonds, coupons plus the principal repayment, and equates the present value of the cash flows to the prevailing market price of the bond, and it can be also termed as internal rate of return. Okay, so you can see on 1st November 2014 you had put in, let's say, 103 rupees is the current market price, and you stayed invested until 15, 16 and 17th year, and if you use this formula you can come to know the yield to maturity, that is 9.6 percentage. So you can read through this. Calculation is shown for HDFC Bank, wherein you can see there is 9.7 percentage on 2017 bond was issued on July 2007 and maturing on 19 July 2017. Okay, with annual payment of the interest assuming the bond is trading at 103 or 2014. So though it was listed in the year 2007, this bond is currently trading at 103 rupees in the year 2014. So all that is left is 3 years, right? 2014, 2015, 16 and 17. And when on 19 July 2017 you want to find out how much is the amount that you would get, and what is the yield to maturity, you can use this formula and you can find out the internal rate of return of the bond. One thing you have to understand is that though it gives you a better understanding of the current yield than the current yield, it has certain limitation, because the assumption that is taken place in this Excel sheet is that it assumes that the bond is held to the maturity and the coupons are reinvested in the same rate throughout, implying that they are static in nature, which is of course an unrealistic scenario. Still, its simplicity is that it can be used for very quick calculation and it can make it popular. Basic funda is that when you are reinvesting something, of course the interest rate would not be the same, it would be different, right? So that is what the scenario doesn't take into account. It takes that static value, and that's why it is easy to calculate. It gives you a very good calculation, but at the same time it's not very realistic. Now let's understand what is duration. Duration measures the sensitivity of the price of the bond to the change in the interest rate. Bonds with high duration experience greater increase in the value when interest rates decline and greater loss in the value when the interest rates increase. Duration, as you know, the term is the time duration, and it's just also measuring how much sensitive is the price of the bond with the change in the interest rate. Let's say you have a bond which is trading at a certain value, and what duration would measure? It would measure the sensitivity if the interest rate is going to change, how much change would be there in the case of bond. Okay, so just to give you an example, what would happen is that whenever there is an interest rate decline, the price of the bond will increase, and whenever, let's say, there is an loss in the interest rate, then the price of the bond will increase. Okay, so there's an inverse proportional scenario that is happening. So higher the time to the maturity, the higher the duration and higher the interest rate risk of the bond. Lower the coupon rate, higher the duration and hence higher interest rate risk of the bond, and lower the yield, higher the duration, hence higher the interest rate risk of the bond. So duration declines as the bond approaches towards the maturity, because there is a lower risk. If the time duration is low, of course the duration is also coming low because of the lower risk that is present. So all what duration does is it measures the sensitivity of the price of the bond to the change in the interest rate. There is also one more thing called as modified duration. It not only finds the sensitivity, but it can also give you a calculation of how much the interest rate would impact the price of the bond. So that is what has been given here also. While the duration gives us the sensitivity of the bond price to the change in the interest rate, modified duration gives us the magnitude of this change. So magnitude of the price change for each 1% in yield is calculated as duration is minus duration divided by 1 plus YTM. YTM is basically yield. Okay. So suppose a M duration is 4.3, then a small change of 0.25 percentage, that is 25 basis points BPS, would mean the price of the bond would change by 4.3 multiplied by 25 by 100 is equal to 1.075 percentage in the opposite direction. Okay, so this way you are able to even calculate the change in the price of a bond because of the change in the interest rate. Okay, and as you know, whenever the interest rates are going low, the price of the bond will become high. Wherever the interest rate in the market is going high, the price of the bond will come low. Now let's understand convexity. What is convexity? Is the impact of the change of the interest on the bond and is inverse but not linear. This is very important thing to understand. Oftentimes, though we say the price of the share is inversely proportional to the interest rate that is there in the market, but you have to understand this change is not linear, or it's not a straight line, it's a curved line. This means when the rates go up, the bonds price go down, but they don't fall as much as they would rise when the interest rates go down by the same magnitude. So you can understand that this thing is not going linearly. It would not mean that 3 rupees change would mean 3 rupees change there. No, it could mean that 3 rupees change could be 6 rupees change, whereas 6 rupees change would mean 9 rupees change. So the curve is not a straight line, it's a curved line. Thus, the rise in the bond price is more than its fall for the same movement in the interest rates in the downward and upward direction, respectively. This unique property of the bond is called as convexity. Okay, so I hope that part was clear. Now let us go into the different types of bonds that are available in the market. Let's first start with zero coupon bonds. Zero coupon bonds are the bonds which do not pay any coupon in their entire term, and that's why it's called as zero coupon bonds. The return on these bonds is not in the form of periodical payment of interest, but in the form of the difference between the issue price and the redemption value. Examples are treasury bills, CPs, CDs, and deep discount bonds and KVP. Say for example, in case of zero coupon bonds, what is going to happen is that the redemption amount or the face value of the share is, let's say, 100 rupees, and when you are being issued this share, you or the bond, you will be issued it at a discount. Let's say for 83 rupees you are able to get this particular bond. So the type of bonds are called as zero coupon bonds because they don't give you any percentage interest rate calculations or anything like that, that you are going to get 8.3 percentage or 9 percentage. Nothing will be given. Only thing you have to know is that you are able to get a 100 rupees value thing at 83 rupees now, and which you can redeem after 10 years. So these type of share bonds are called as zero coupon bonds or ZCB. And who are the ones who are issuing these? These are treasury bills, CPs and CDs are often issued as zero coupon bonds. Now let's understand what is floating rate bonds. These are bonds whose coupon is not fixed, as in the case of vanilla bonds, but is reset periodically with reference to defined benchmark. Such bonds are useful in case of rising interest rate scenario, as they continuously keep tracking the interest rates prevalent in the market and adjust their coupon periodically, typically 6 months. So as you can see in the case of floating interest rate on home loans, this is exactly an example of a floating rate bond. You know, depending upon the interest rate that is prevalent in the market, in case of if you have gone for a flexible home loan, it would happen that depending upon the interest rate that is prevalent in the market, your interest rates on the loan would also vary, right? So that is an example of floating rate bonds. In some cases, they can also have a maximum and minimum limit to the coupon rates in the floating rate bonds, and these limits are called as cap and floor. The top one is called cap and the bottom is called as floor. So housing loans with variable or floating interest rates are an example of this type of loan, which is called as floating rate bonds. Okay, so based on the different benchmarks, if there is a fluctuation in the benchmark, the floating rate bonds coupon rate will also fluctuate accordingly. Now let's understand what is convertible bond. Convertible bond or debenture is generally issued as a debt instrument with the option for the investor to convert the amount invested into equity of the issuer company later. So they are, though issued as bonds, the investor has an option sometimes it's compulsory, sometimes it's optional to convert them into equity. And this conversion also is coming with many options, like you can either convert the entire thing into equity, which is called as fully convertible bonds, or you can go for partially convertible also, wherein not the complete amount will get converted into equity, only the part of the amount will get converted. In case of partly convertible bonds, the remaining amount which is not converted will still remain as debt, and it will give you the interest rates, which is again repaid back in the time of maturity. So basically it has got an advantage for both the parties. The advantage to the issuer of the convertible bond lies in the fact that the convertible bonds usually have a lower coupon rate than the pure debt instruments. Okay, if you go for, let's say, have a pure debt instrument giving 8%, this will basically give only maybe 6%. Moreover, the issuer does not have to repay the debt on the maturity, since the shares are issued in lieu of the repayment. So in traditional bonds, what will happen, the person who is taking the loan has to repay the amount, principal amount plus the interest rate, right? But if, say, this person exercises the right to convert this bond into equities, then he doesn't have to pay the money back. All he has to do is it has to allot the shares, right, instead of the repayment. But also there is some disadvantage, because when this person is converting his debt into equities, what is going to happen, the existing shareholders stakes are getting diluted, because the fresh shares have to be issued at the time of conversion. So individual persons who are the initial shareholders, their stakes are going to get diluted, as the number of shares that are there in the market will increase for this particular company. Okay, hope you got it clear. Now let's go on to amortization bonds. Bonds usually pay interest during the tenor, and the principal is repaid upon maturity. That is how the normal bonds function, right? You are basically given an interest rate during the duration, and at the end the principal amount that you had paid will get back to you. But in case of amortization bond, it works differently. Each payment carries interest and some portion of principal. And I know you are familiar with it, because housing loans also work in the same way, right? When you are taking any housing loan, the amount that you are paying back as EMI will have a principal component, and it will also have an interest component. In this case, what is going to happen is the principal amount will be very low, and the interest amount will be very high in the initial phases, and slowly towards the end the principal amount is again going to be very high, and the interest amount is going to be coming low as you come towards the end of the duration. So amortization bonds also work the same way, that each payment will carry both the interest as well as the principal amount. Okay, so there is no need to pay a bulk lump sum amount to the person who has invested in this bond. That is how the amortization bonds work. Now let's come to callable bonds. Callable bonds allow the issuer to redeem the bonds prior to the original maturity date. Okay, so callable and puttable. Again, we are coming to option trading somehow, but I will make it clear for you what is callable bonds means. So let's see that as an issuer of the bond, that means somebody who is a borrower, he is the one who is issuing the bond, right? And he issues a bond with a duration of, let's say, 10 years, and then he comes across a situation where the interest rates are falling. So then issuer is able to basically has the opportunity to create a new bond of the same loan amount at a lower interest rate. So it would be advantageous for the issuer to redeem the existing high cost bond before the maturity and replace it with a new low cost bond. To compensate for the risk, the investors of the callable bonds also have a usually high coupon bonds. So investor in the callable bond, however, loses the opportunity to stay invested in a high coupon bond, and if the call option is exercised by the issuer. So one thing that you have to understand, friends, is that in case of a callable bond, the person who is issuing the bond has the right that whenever he wants, he can redeem those bonds, and he doesn't have to really carry this contract till the maturity. And now the question is, what would be in his interest, or when will be the time when this person would use this rights that he has? It will be only in the scenario when the interest rates are falling. Okay, say for example, he has borrowed 1 lakh rupees from you for 8% coupon rate. Okay, and now the interest rate in the market has fallen to 5%. So why would he take the loan from you? right? He would basically close the loan from you for 8%, and he would take a fresh loan for 5% interest rate. That is what will make sense to him, right? So this option is what the issuer will have if the bond is called as callable bond. He would basically close your the loan that he has taken from you, and he will take a new loan for 5% interest rate. Okay, and this option is given only in the case if the bond declares that the bond is of callable bond nature. Okay, and just because this seems a bit unfair for the investor, usually you will find that the callable bonds have a higher coupon rate. So normal, if a bond is giving 7%, 6%, this will give you 8% interest rate, because this has got special rights for the person who is issuing, that he can call this off anytime he wants. Okay, so investor in the callable bond is also suffering a loss, because this person is calling off, is because if the interest rate in the market is 5%, and if this person was holding a bond which was giving him 8% return, and if the person is taking back the bond, then he's losing off this opportunity to get 8% return on an annual basis every year, right? So that sums up what callable bond means. Now let's talk about puttable bonds. Puttable bonds gives the rights, this time not to the issuer of the bond but to the investor of the bond. It gives the rights to seek the redemption from the issuer before the original maturity date. So I am an investor, okay, and I am giving a loan to the person for 1 lakh rupees at 8% interest rate. Now I found that in the market suddenly the interest rates have got risen up. Okay, there are people who can give me better interest rate like 12 percentage. Okay, so what I would basically want to do is I want to take my money back and I want to invest where I get 12 percentage, and this type of rights is available in case of puttable bond. So what would happen is that I would simply ask my money earlier than my maturity and invest that amount in the place where I can get 12 percentage. So if the bond offers these type of benefits, they are called as puttable bonds. Now let's understand payment in kind bonds. These are not very common among retail investment. These are bonds in which the coupon is not paid in cash but by way of more bonds. Companies which have cash flow problems issue such kind of securities. Hence, by nature, these instruments are risky. Say I am a company and I am not having enough cash. What I can basically do is I can issue bonds on the bonds, and this is what is called as payment in kind. Okay, these are bonds in which the coupon is not paid in cash but by more bonds which are given. It's basically like loan ke upar loan lena, we say it in Hindi. Okay, next thing, principal protected note. Principal protected note is relatively a complex debt instrument which aims to providing protection of the principal amount invested by investors. I don't know how many of you must have invested in ULIP. ULIP also works in the same principle. It is called unit linked insurance plan. So what happened basically in case of principal protected note is, like, if say you are investing 10,000 rupees, what they would do is that they would invest 4,000 rupees in a debt instrument, and that would generate enough interest that it can repay you the principal amount, that is the 10,000 rupees that you have given, right, over a certain period of time, of course. But the remaining 6,000 rupees they would invest in areas where they can get more interest, wherein like equities, derivatives or commodities, wherein they can make some potential of generating high returns. So these type of instruments are called as principal protected notes, which are basically a mix of both equity and debt. But since it is offering you the principal preservation, it is coming under the debt instruments. Okay, while it still gives you an option that you might be ending up getting a better return than the market, because of the exposure to the equity market. But at the same time, you can be sure that the principal amount is protected, because it's only going to get investing in the debts to make sure that at least the principal amount that you have paid is basically protected. Now let's understand inflation protected securities. So of course, any idea of investment is to protect ourselves against the inflation. You know, the inflation current rate is around 6.5% to 7%, and every instrument wherein you are putting in the money should ideally give you at least inflation protected returns. So for helping those people, the RBI has issued certain bonds which is called as the inflation protected securities, in which what is going to happen is that depending upon the inflation index, these government securities will give adjusted returns to the customers, because most of the people who are invested in bonds might be people who are old or maybe nearing the retirement. for them, they don't want to lose out of this money, right? So what they would do is they would tie up the returns of this investment with inflation, so that you don't lose because of the inflation. Your returns are at least protected against the inflation. So if you have an year of high inflation, you would get a higher return. If you have slightly lesser inflation this year, you will get slightly less return. So that's how the government is basically trying to protect the old investors by giving inflation protected security. Now let's come to the question and answers. The very first question is, a bond is issued at a face value of rupees 100 and a coupon of 10 percentage per annum. The interest rates in the market have increased subsequently. The bond is likely to quote at. Say for example, now here you have seen the situation, you know the face value is 100, a coupon rate is 10% per annum, but suddenly the interest rate in the market has come up. What is going to happen if the interest rates are going up? The price value of the bond will decrease, right? So the question is that this bond is likely to go at a price above the face value, at the face value, at the price that reflects its credit risk, at the price below the face value. So friends, the correct answer is at a price below the face value. So when the interest rates are rising, the price value of the bonds will go down. Okay, that is how the market or the logics work. Now, the dash of an equity share is the discounted value of its future benefits to the investor. Okay, what is intrinsic value, replacement value, market value, and face value? This is something you already know. It's intrinsic value. So intrinsic value of an equity share is the discounted value of its future benefits to the investors. Now let's go to the next question. Calculate the enterprise value based on the given information. So enterprise value formula, I hope you already remember, but I will still show the entire calculation to you. Let's understand the question. Market capitalization is 10 lakhs, debt is 3 lakhs, cash is 4 lakhs. To find out the enterprise value, what you would need to do is add up the market capitalization of the equity plus market value of debt, and you have to minus the cash and the cash instruments, and the number that you get is 9. So the correct answer is 9 lakh rupees. Okay, enterprise value. Bonds which have embedded call option in them are known as callable bond. State whether true or false. So of course, this is what exactly I explained earlier, that bonds which are coming with the call option is called callable bonds. So this is a true question. So friends, with this we are almost coming to the end of this chapter. Just wanted to tell you that we have got the latest question and answers of Research Analyst Examination in our website mocktestchannel.com. So please do go and check on them. They get updated every 2 weeks. You get all the numericals along with their explanations in this website called www.mocktestchannel.com. I will put the link in the description along with the special discount coupon code for all my YouTube friends. So if you found this video, please hit on the like button and press on the subscribe button also. Depending upon how many likes I get, you will find the next video very soon.